TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-4. Now, Basil Chapman.
Hi everyone, Basil Chapman. My pleasure to be here Monday through Friday and sessions that we should have because there are certain bonds, the whole shebang. We'll go through that as we go through each one of these charts. And most importantly, two things are happening right now. The one is, I had mentioned to my subscribers ages ago, I said, the best thing would be to buy a little bit of Cuba, that's the ETF, the Hertzfeld, I think something Caribbean Basin ETF, and just sit, because at some point you just know that the economics of the cruise industry are going to, and this is the CRUISE cruise industry, are going to determine that the new place to be is Cuba. And it's got nothing to do with ideology or anything like that. It has to do with money. But look what would have happened if you bought that. Yeah, today you'd be looking pretty because in another hour, the president is going to talk about Cuba. We knew that it was just a matter of time. So you would have been sitting here with Cuba in your portfolio, watching it go. Well, it was a long time ago. Let's just say it was 3 years ago that I mentioned it. Anytime 3 years ago, you would have been in the 7s or 8s or 9s, but it went all the way down to 6 something or other, 638. So having a 30%, 40 or 50% decline. So why, sometimes you can have a great concept, but having the patience to fulfill and having the temerity to be able to sit through all the gyrations in between, it's very difficult to do. But this is a chart that is worth looking at. 934 just yesterday. Yesterday it was down at 681, up 37% right now. Hey, let this thing come back down and it all settle down. Let there still be a little conflagration between different factions of the yes and the no's. You know it's going to go through at some point. So all we're waiting for is seeing this. Someone remind me, please. Just send me an email or text me or something. When it gets to, it's at 935. When it starts to test the between 788 and 760, the 200 period exponential moving average, wake me up, and we'll see if it's worth getting it. All right, so let's go back to this here. In fact, we'll just run the numbers in looking at the charts. If you look at the I always put this, it's not ESH 14, it's ESH 15. Very different chart, different price. Trading at 1980, up 15 points in the E-minis. Sounds fantastic, but yesterday it was one of those unbelievable days. Do you realize to make a leg A in the E-minis at this particular point, either there has to be whatever the high is today, there has to be a lower high the next day, and then a higher high to start a new A, or this move today has to soar above yesterday's high of 1982.50. What am I saying? 2011.25. Who knows? But that's going to be tough to do. Most importantly, I keep wanting to show the S&P futures, the March future weekly chart. This is so important. Why? Let's just say that we close out with some kind of a doji on Friday, somewhere in the area of 1989, okay? And then, for whatever reason, the following week, Christmas week, we go underneath 1961.50. We don't even have to close it. We just have to break under that. That would suggest that I now have to seriously think that the stochastic is going to drop below 80% and make that double hump pattern that I always talk about, the H that goes to an M pattern, but in the slow stochastic. So we're going to be watching that. Look at the 120-minute chart right here of the E-mini. This is actually the move that has the potential to be one of the better ones. Why? Because it's so slow and determined. There's been no pullback for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 for about 10 2-hour bars. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, whoops, 11, 12. Last time there were 12. It went at 2 o'clock in the afternoon on the 11th of December, and then it plunged. So maybe I shouldn't say anything. Let's see where this goes to. But there's that dash trend line resistance at about 1986. So, okay, let's run the numbers. Here we go. The Dow is up 94. I'd like to do it with the charts because I need to talk chart language right now. I don't want to get involved with anything that is, oh, I'm going to do this before I move on. I don't want to really do it with anything that is going to be emotional. It has to just purely be technical. I need to do this because I am almost sure that I did this last week when I was sitting in, I think, for Darryl. And I showed, I think it might even have been Thursday, and I showed the feeder cattle continuous contract. And I know I had everything ready to do it. I might have had a call, and I didn't get to it. I hope I got to it, because it was a perfect demonstration. That's why I wanted it. Feeder cattle on the continuous contract had made a peak E on the 17th of November. It pulled back, and then it made the pattern, and I'd already drawn it in. So I don't remember now what day this would have been. I've got to about the 10th. I don't think it had already broken down at all. I think it was about to. And what I wanted to say, if I didn't say it, was this is typical in the Chapman wave methodology. This is typical of, let me see if I can get it right now. This is just typical of a pattern that we look at, and it's occurring in many places. It's really important. I remember I spoke about it when I spoke about gold ages ago, over maybe 2 years now. And what I had said was that that pattern is formidable in that if you are looking at a pattern that makes the Chapman wave right shoulder failure pattern, this is chapter 21. It's the one that leads to the cascade that I call the the cascade that I call the dreaded H. So this is the pattern. Right here, you remember I spent some time on this a while back. I had spoken about the Dow in 1987. I had this perfect sell signal the very first time that I'd actually formally done with the institution Fidelity as one of my first big clients. And I got this pattern that gave me in the hand chart of the Dow on a closing price basis, the peak E, and it pulled back, and it came down, and then it ran up and made an exact unchange at about 1240 or 1160. I don't remember what, but it was an exact close on the day, and it was this pattern that went up like this after a major top. Well, I didn't know it was a major top, and then I said if the next day the Dow is down with a 0% change, if the Dow is down 60 or more, that is real trouble. Well, that's the same pattern that we're looking at here. This is that right shoulder failure pattern that leads there. Oh, there it is again, right there. This is now GM chart when GM was trading up there in the 50s back in 2003. Now, what's really important about this particular pattern is it leads to the pattern that goes to chapter 17, right here, to this one that I call the scallop pattern that just keeps coming down. See, there it is. There's another one of those right there. It turns around, and it makes all these arch formations, and eventually you might get something that looks like this, the lowercase m. That's what the gold, the GLD, did. Okay, let me go back to my story. That is the pattern right there. The Chapman wave right shoulder failure, that's usually at a peak A or B minus, because it takes out the left side low. After it does that, it breaks down, and you can get a 1-to-1 to the downside. Well, it turns out that it's limit down. This must be limit down. Limit down for 2 days here. And look, there it is in the weekly, and that says that trend line right there, I'll show you exactly what it is. It's a 32-period exponential moving average right at 214. That would be the downside, first real support that I'd be looking at. But this is really something. Anyway, so now let's get back to our story. INDU. You can see how I can go. This is how I developed all these techniques, because my mind tends to wander from the next thing to the next. To me, it's the next logical thing to the next logical thing. I'm sure to others it is just off the wall. Anyway, the Dow made a high of 17,991. We've not yet had a leg A to the upside, even though it could be an A minus. I've got to watch this so closely, because at 86%, the stochastic in the weekly is still good. The MACD is just about across negative, and the prices for the second week in a row might be under 17,405, under the 9-period exponential moving average. I don't even want to talk about the exact time limit. Look at this, 43 bars from the high of 2007, October at 14,198. Plunges down to the March low. Remember, we got that exact low, the day of the low of March the 6th in the diamonds. At 64.69, the Dow hit and then turned up, and it made an exact move to the left side, right side. There was a different way of measuring it at that time. But it went to, on the May of 2011, went to 12,876. So that was 43 weeks. Months, 43 months. Well, from that high to the bottom of 10,404 back in October of 2011 to this month that's made the all-time high of December, it is 43 months. So as far as I'm concerned, with leg E, it might recycle. I don't want to talk about the month until it's finished, because there are too many ifs, ands, or buts, or whatever it is. And so let's just leave that for the moment, because there's nothing to do about the monthly chart, other than to say a close on a monthly basis for the very first time. Also would be only the second time since the breakout in November of 2011 above the 9-period moving average. And the one time it broke and closed underneath was in May of 2012. This would be the second time. And that's always a warning to say, be careful from here on, because you are starting to show that that 9-period moving average has stopped being a propellant. It could become both a magnet and a repellent. We don't know. So let's just leave that. We have to wait for about a week before we get 2 weeks before we get the end of the month. And most importantly, it's that weekly chart that is next. So Dow is up 90 at 17,160. Most importantly, a close below the low of 17,000 into the 16,900s would just have, I believe that the fund managers, the reason why the VIX has been rallying so well is because fund managers did not want to give up those gains, but they wanted to buy insurance, and that insurance has kept it high. If you break 17,000 support in the Dow and the equivalent in the S&P, those guys will give up their stocks, because the VIX won't help them that much.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, the Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Check out the new look of Tiger TV. Now you can see all hosts, charts, and computer screens live in high definition. Whether it's Tom O'Brien, John Logan, Steve Rose, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Thinkorswim, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV. Now, crystal clear in high definition, 24 hours a day, 7 days a week. If you haven't seen the new look of Tiger TV, then visit TFNN.com. Basil takes your phone calls. Now, toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks. I moved on again. Greater Boston Bubble Watch. I just picked this up. It's from the Boston Globe. This guy, Scott Van Furis, he writes quite well, but he writes from the perspective of a novice in the real estate business. It's very interesting, and he does the best he can, but when you look at it, you just say, wow, he's not lived through certain things. However, what he's done here is he's got the bubble chart, and he shows all the prices in the Boston area. What a chart. It says, Tom Scayan recently shot me this provocative graphic in hopes of raising the alarm over what could be yet another real estate bubble. Now, when it's in the Globe, you know that you're not going to get a bubble. It's going to have to wait. So this is going to have to wait, and look at the buildings that they've got here. Remember we talked about skyscraper? When I came to Boston, the Prudential was already built. And I thought it was an ugly building then, think it's an ugly building now. But they've got a brand new building. This is not right over here on the right, would be the John Hancock. I love that building, IMP. One of the most expensive plywood buildings in the world. I have pictures of it as it went up, because I used to live just over there near the water on Marlborough Street, and I watched this the John Hancock going up, and then they had to take all the windows out, a glass building. They took all the windows out because some of them broke, and they had replaced them with plywood, the world's tallest plywood building, and then they put the windows back again. Big lawsuit. Anyway, it was a defect in the glass, so a mismeasurement. That's really what it was. So now there's this new building. Take a good look at the glimmering new condo and hotel skyscraper in this rendering. So 58-story spire slated to take shape next to the Christian Science Plaza in the Back Bay. One of a trio of new towers poised to bring New York condo prices to the hub. So we got a little time to go, but watch out. All right, let's get rid of this because it's in the future, and we want to deal with the present right now. So I just ran through my my Dow Quartet. GE looks horrible. IBM looks horrible. Triple M looks, let me take that. That's a 120-minute chart. Let me move that away. Triple M looks excellent. Still very, very good. B, I have to call that B in the weekly chart, and that portends higher prices. And that's the reason when we're done with this consolidation, which the way it's looking might go into January, I don't think we're going to have a December rally at this point. But when we do get the rally, it's going to be a huge one. And UTX, which was looking great, then looked terrible. Now it's having a 50% recovery. Going to watch this closely. So Dow's up 116 at 17,186. The S&P is up 17 at 1990. The comp index is up 31 at 45.79. Gold is up 1 at 11.95. Silver's up 7 cents. You've got crude oil, is up 28 cents at 56.22. I think we got a little bit of a turn here in crude oil. And bonds, I don't have time to do that, but I do want to go to our first caller. Here's the TLT. It made its leg D at 127.72. We were waiting for it to go 1 penny above 127.68 for a daily D, a weekly D, a monthly D, and a 120-minute E, and then it could have a little bit of a pullback as the market bounces. That's what I think we've got, and we're going to go to George in New York. Hi, George. How are you?
Basil, good morning. How are you today?
Oh, Mr. Staples himself. Look at that, folks. You got the call months ago about Staples trading in the 12s and 13s, and today it's at 17.38. Thank you, George, for all that information. And
thank you for all your help.
My pleasure. And you'd like to look at?
Basil, today I wanted to look at Royal Dutch RDSA.
Wait a minute. That used to be RD, wasn't it? Royal Dutch?
Years ago it was Royal Dutch, and then they spun it off to...
Oh, it's the A shares. Got it. Okay.
Exactly.
Okay.
Anyway, of course, all the majors broke down.
Yes.
Royal Dutch, BP, so forth, so on. Here's the question I have for you. Where do you really see crude oil settling at?
Okay. I spent some time on the crude oil, and I spent a lot of time on the chart. Now, what I discussed is that if I go to the continuous contract of crude oil, it seems to me that the pattern, and I'm going to pull up this chart once again. Funnily enough, I just discussed it. You see the resemblance here to slide 335 in my CD introducing the Chapman Wave methodology, my CD book that's available at TFNN. Well, if you look at the dreaded H pattern, it keeps coming down in those scallops with the H, a lowercase h, breaks the left side support, and the right side goes lower down. Then there's a little rally, and it fails. And then that becomes really important because a decisive break under can give you a one-to-one to the downside. But let me talk about something else. George, we've got a break, and I'll be right back. We'll talk about crude oil, where the possibility is for it to settle. I'll be right back.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hackle Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Each and every time that the dollar ticks higher, S&P wants higher price. Each and every time that the dollar's ticking lower, guess what? S&P wants lower price. Dollar, the metals, and the S&P are going tick for tick.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Back. So this is the first, yesterday was the first sign that crude oil was trying to establish some kind of a bottom. It did that in the daily and did that in the 120-minute chart. It's best to have the next day to see a follow-through before getting too carried away. But if you are trying to be a timer, that's different altogether, because if you got in yesterday or even right now, somewhere around the 57s area. 60 is really the 9-period exponential moving average, which it hasn't even touched since it broke down back in November the 20th. So on a short-term basis, it's going to be very important where this bounce goes to do what it should have done with that left side, right side price time test. So I'm going to the monthly chart, and this is my suggestion. It's pretty much the same thing as you would expect in the weekly or the daily chart, except I want to use the very long term from 2009 February, the low of in the continuous contract 63.98. Depends on what system I'm using, TradeStation, which gives me this information. That's what I'm using. The date the price might be different, but the dates should be exactly the same for all the moves. Now, what's really important is that we've smashed through that level, and what did I say? I should have typed that in. 63.98. Well, 66.48 was the close in November. So this is December. So my rule of thumb is that in this particular pattern, the price that eventually takes out the most important left side low, that's the low of February of 2009, has to within that bar, or at the latest, the very next bar, that makes it January, has to have a turnaround that goes back into the arch formation. In other words, it has no choice but to close higher than the close of February of 2009. In this case, it's 63.98. And if it can close in the 64 or higher area, that says two things. It says, one, now you can get a little bit more of a bounce, which should go to the most important next important measure of either a moving average, a gap, or a peak. There's nothing here until it gets to 80. I have a difficult time seeing a bounce to 80 after everything that's happened, unless we're making an absolutely critical major low. And the stochastic at this point in the weekly chart is saying, no, it's a low, it's not the low. So 69 is the 9-period moving average resistance in the weekly chart. So here's my anticipation, and I'm going to just I'm going to type it in right now, as I did with gold back when I got that sell signal back, I think it was September or October a couple of years ago, and I'm going to draw in this arch formation, which says there should be a bounce of 14 points or so towards the candle that really, that doji candle of the week of the 5th of December, 69.87. There's a possibility that it could go a little higher, but it's still going to be the arch formation. In fact, I'm going to make it a little higher for now, just to show that there is a potential for a rally of time and price, which says that somewhere round about mid-January, if this is going to be a rally of substance, then crude oil could rally a couple of weeks, a few weeks. That is at this point, there has to be no new low to the low that was made yesterday, or at least a no closing low. It has to really move up, and every retracement has to be a higher low and higher highs. Because if it takes out decisively, if it takes out the low of 53.93 on this continuous contract, and I'll just give you the number on, I'll go to H just for now. So on the March contract, if it takes out the low of 54.33, if it closes below 53, that is really ugly action. I'm expecting that the market has a bit of a bounce right now. Crude oil has a bounce, and then crude oil kind of gets dismissed for a little while, and that crude oil eventually comes back and tests the level, this particular level that we're looking at now. Now, we didn't get a climactic volume spike low yesterday. That says to me we can expect that there will be lower lows to come in crude oil, but I'm anticipating that at some point by early January, there is a test of the low bar that was made in November. And in this case, for the continuous contract, it's at 66.02. It's about a point or so different from the actual futures price. So that's what I'm anticipating. And then I think it comes back, and it starts basically a new level of trading with lower highs and lower lows. That's the way it's looking right now. I will modify that if there is speed involved in the move to the upside, and if by Monday or Tuesday of next week, crude oil is trading at 62, then I have to say, you know what? This could be a V-shaped decline. We could have even a longer bounce because of the oversold condition. That's the way I'm looking at it. A lot depends on how for instance, when you put it together with XOM, the chart that H pattern that was formed in the weekly chart and the one in the monthly says, hey, there's going to be a lot of resistance in the 94 area for Exxon trading at 89. So that's about 5 points higher. If you look at CVX, it's pretty much the same thing. A little bit better chart pattern in one way, and a little bit worse in a weekly chart.
What about Oxy?
Now, Oxy, as I looked at it the last time, was the one that never made new recovery highs. That's the one that's the one that has a lot more. That's the one that's making more lower lows and lower highs in the monthly. And it says that most importantly, if Oxy takes out 72.43, the low of the week of the 30th of November,
Yeah.
it's in real trouble. And right now it's trading at 77.
Exploration, while the others are more integrated. Okay.
Yeah. So, and right now, regardless of what the Fed's really, what can the Fed do? The Fed doesn't want to shake anything up right now. They're going to give some good news. So we are still short in my opening call. We have a long position that's up almost 10% in a couple of days. We took some profits today.
Nice.
I think that this is a bifurcated market just in some areas where there's strength, but now I'm looking at areas that were absolute leaders that are very weak, like the IBB, which is the iShares of the NASDAQ biotech area.
Yes.
I want to go back to this, if I can. I won't be able to find it. It was from No.
You know, there's a small company I've been following, but of course it has no earning history publicly, but it's a company called Exact Sciences, EXAS. EXAS. They have FDA approval for a colorectal test.
Oh.
It's a home kit.
You know, I actually read about that.
Very interesting company.
Yeah, I never heard. I didn't do anything. I mean, that's all I remember. I wanted to just show something. I'm trying to find today's Globe has a whole thing on the biotechs, what they're doing, buying all this property. I spoke about this about 4 months ago before the October smash in the biotechs, that 22% decline. They are the biggest holders of property in the Cambridge, Boston, Alston area, and there's a whole thing about it and how much they're going to spend, as well as, look at this. This is the new design for developer of International Place, Don Chiafaro, is Boston's answer to Donald Trump with an outsized personality and a penchant for big talk. This is what's written in the Globe, and now he's got this new Twin Tower complex near the New England Aquarium. Beautiful building, actually. Look at this stuff that's going on. This is Boston, conservative Boston.
It is, yeah.
So I love modern architecture. My brother was an architect before he was a city planner. So I've always loved beautiful buildings. I hate that building in that cucumber building in London, but somewhere around the world, especially in China, there are incredible buildings. So I want to bring that up in terms of the biotechs. So I don't see any reason why we don't rotate back now into the oil-type stocks for a counter-trend rally, more than maybe a 3-day bounce. Maybe it even goes into early January.
What's worrying me, I am looking on a secular chart, on a 20-year chart of crude.
Yes.
And I'm thinking, if we take out whipsaws, let's say back in January 09 to March, when the market was really crashing at that point.
Yes.
And I eliminate the whipsaw and I follow the trend line. I'm looking at either in the high 40s up to about 60 to level out at crude.
Yes. So here's the pattern that I wanted to talk about. I don't talk about this pattern too often because it requires a whole bunch of things to occur for it to actually take place. And when it does take place, it's usually too late if you haven't anticipated it. But normally what I would anticipate, because you'll see that in the GLD, this is exactly the same pattern right there. Right at the top, there was more than a 1-to-1 to the downside. So if I go back to the that's gold. If I go back to crude oil, it's suggesting that at least from the last high bar, right there, we could make a case that based on the technicals, the weak MACD and the falling stochastic, that we get another move down. Normally, I'm very conservative in this thing. I started from the trend line itself that was broken, and that takes you. We've just gone underneath it. Then I move the trend line, and that would take you down to around about 46.
Okay, so it's following my thesis as well. Okay.
Okay, so that's what I'm looking at. So over a period of time, this is the first time that crude oil has been attacked by fundamentals rather than politics. The fundamentals are that there are alternate resources. The fundamentals are that it was really an artificial way of keeping prices up. And the fundamentals are that once the technicals have been broken, you can rely on the technicals to continue the pattern. And in this particular case, those H patterns that go into the continuous M pattern says that if it breaks down and it breaks decisively the left side low bar, it has 1 or 2 bars to get back in to the arch, and if it fails to do that, it is a very quick move down, and that move can often be a 1-to-1.
And also, I think what we have now is we have, honestly, an oversupply at a global market, because you have so many countries, and now, of course, you have the U.S. again with the shale production.
Correct.
So the problem is, and this happens in any business, and I've seen it in manufacturing business all my life, there becomes a point where everybody gets in on the bandwagon and they start overproducing. Then once they overproduce, you have oversaturation. And you need that supply to whittle down. And sometimes what happens in a lot of industries, the weak players get taken out.
Well, what happens is two things happen.
You start having a little bit of bankruptcies in
the weak players don't have the capital to continue. Just as Macy's is still looking good and JCPenney is just falling apart.
That's
right.
So
you've got the big guys have the bucks and they can survive. And the little guys just fall by the wayside, and eventually and this is what's going to happen. I'll spend maybe sometime next week. I'll spend a little time talking about how it happens in business, as you say, in the arts and everything. You go from sparsity to excessivity, and during that period of excessivity, you get in the Boston area alone. There were hundreds, if maybe even thousands, of automobile manufacturers in the late 1920s, early 1930s. Eventually, that whittles away, and you get your 3 major companies. We saw that in Exxon. We saw that in the oil, the integrators. We've seen that in almost every field. That eventually it's going to happen in the high-tech area.
Even the telephone companies after 81.
Telephone companies, correct. And eventually, what you get is you get just a handful, and it becomes almost a monopoly. It was 1906 when there was that campaign to break up. Was it Standard Oil? I think it was Standard Oil.
Yeah,
so what you're talking about, that's what I'm going to be looking at in the biotechs. I think that we're going to get to a point where the pharmaceuticals companies start to take over biotechs and vice versa, and it just whittles away, and in maybe 5 or 7 years' time, we're looking at just a handful. Wow, talking about 5 or 7 years' time, I didn't have a chance to talk about it. Yesterday I'd spoken about the age of the dandy. Today I wanted to just mention there's something going on here in the arts that's going to be very important. So I'll talk about that as we move on. But it's the same thing in the arts, that the big guys have started to do double the size of the institutions, and now you've got the small guys like the Gardner Museum in the Boston area, but you're getting it all over the show. Boston College has got a huge thing going on. So we'll talk about that, because there's a penalty to be paid, as exciting as it is, and we'll see what happens. And just like you say, and it's the same in business. We'll see what remains in a few years' time and what doesn't. Hey, George, thank you for the call.
Basil, thanks again for all your help.
Thank you. We'll be back, folks. Dow's up 143.
You take a hands-on approach to managing your investments. And whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
TFNN has just announced a special sale for the Gold Report for a limited time only. To celebrate the 660th weekly issue of Tom O'Brien's Gold Report, that's more than 12 years, TFNN is having a special one-time sale. Right now, you can receive 60 weeks of the Gold Report, that's 14 months, for only $600. We're offering Tom O'Brien's dynamic weekly newsletter at only $10 a week, half off the regular monthly price. By taking advantage of this special offer, you also get a signed copy of Tom O'Brien's best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, an $88 value. The Gold Report is published every Tuesday and provides subscribers with Tom O'Brien's expert commentary on the industry, as well as detailed information on a variety of mining equities. This offer is valid for current or new subscribers, but is only good through this week and ends this Sunday, December 21st. Lock in the low rate of only placing your order at the front page of TFNN.com today. Since 1980, traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman wave sequence. Using the Chapman wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartley's, butterflies, ABCs, and Fibonacci in order to trade these markets. Trade what you see. Next on TFNN.
Hi, folks. So we had a couple of email questions and a couple of questions in the den. Let me just quickly go to the XLE, which is the... two things here. XLE is in leg D in the weekly chart under the 9-period moving average. It's trading, this is the S&P Select Energy Spider. It's trading at 77.16, up 314, up 4.25%. Nice move to the upside. I'm also expecting that it gives you that H pattern. I wouldn't be surprised if 79 to 81 is really the target area of the two moving averages in the weekly chart, and then we might see another H pattern unfold. Hey, if the speed is involved, it might go a little higher. We'll see what happens over the next 3 days. If it's in the continue, this is a V-shaped pattern. That's number one. Next thing I was asked about, could I talk about, what was the question? Whoops. If you have hey, Basil, if you have a moment, could you please cover your longer-term prognosis for the markets if indices show weekly sell signal? Is this the top, or do you foresee continuation of bull market after pullback? Thanks for any thoughts, Chris. This is a rotational correction, like we've seen all the way through. It's becoming a little more serious in the sense that the winners from before, like the SMHs, are somewhat vulnerable here. We'll see how they close Friday for the weekly chart, which is really important. And we'll look at the IBB to see how it closes. But I suspect that we're looking at a rotation that says some other stocks are going to carry the day. But until they can find and establish some kind of support, you've got to be very careful because there could still be further downside action. The VIX index is telling me, and this is what I discussed yesterday, that based on the 120-minute chart, one of the reasons why we're out the VIX, I'm waiting for something to happen here. High-level consolidation. I think fund managers are still using the VIX because they're trying to keep their stocks as long as possible. How this unfolds is going to be important because if their stocks fall precipitously, they're not going to have enough. They're going to be taking a loss. They're going to get rid of those stocks. That's going to be important. So watching how the VIX closes on a weekly basis, really important. Made a big deal out of it before. We made some nice money on the upside. We're out right now. If the VIX closes well into the 20s on Friday, that's one thing. If it closes back between 18 and 16, especially closer to 16, that's going to be telling me something else. So I'm watching both the daily, weekly, and monthly for both the week October. At this point, I still don't think we're going to break that low because of the rotational aspect. How we rally over the next day or so is going to be very important. Why? Because if there is a rally material, the Dow is able to into the 17,000, a little higher, it's going to be telling me one thing. If it's only able to get on and then fail by the end of December, and it's trading, the Dow's trading between 17,200 or under 17,000, that's another story altogether. And then we're looking at time and price going to the first quarter of next year. But if it's able to rotate, find enough stocks to keep the market holding well, we will find, and my whole skyscraper theory and everything about it, even with this 43-month exact time price move here, they're going to tell me that it's a top, and right now I don't see that. I see a pretty serious decline, and I'll go into that further tomorrow. Meantime, it's really important that you listen to Larry Pesavento. Larry's going to have a great show as always, and I'm looking forward to it. Dow's up 180, S&P's up 27. This might be the first time we don't actually reverse up and down 200 points, but instead we close up over 200. We'll see what happens. I'll be back. Cool.
David White's newsletter, The Tech, ending the next big things into invested $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever. You're ready to ride the next big technology bull market for less than $40 per Technology Insider. Get in on the ground floor of the next big thing today.
This is